Right now, a single, largely unseen financial sector directly controls over $7 trillion in global assets worldwide. The firms at the top of this hierarchy, names like Blackstone, Brookfield, and Apollo, act as the world's most aggressive buyers, acquiring everything from medical technology manufacturers to massive wealth management platforms. The executives orchestrating these portfolios oversee larger financial institutions than most traditional banks. Yet, unlike the companies traded on public stock exchanges, these businesses are taken private. They operate away from the daily scrutiny of the trading floor, making their massive economic footprint largely invisible to the public. Private equity has evolved into the entity responsible for managing the operations and debt of thousands of companies across every major sector of the economy. The industry is built on a specific commitment. Investors lock up their capital for a decade in exchange for returns that aim to significantly outperform the public stock market. By 2026, that process is stalling. The industry is currently fixated on a specific metric called DPI, or distributions to paid-in capital. It measures the actual cash returned to investors compared to what they originally put in. Historically, private equity funds maintained a return rate around 16%. The limited partners are the pension funds and endowments that supply the vast majority of the money. To cover operating costs, the managers typically charge a 2% fee on the total capital every year, regardless of how the investments are performing. The real incentive is the 20% carried interest fee. The managers only collect this once profits exceed a minimum threshold, usually around 8% per year. Once the returns cross that threshold, 20% of all remaining profit goes directly to the firm. This structure prioritizes high-stakes growth. The managers only earn significant wealth if they can manufacture returns far above the standard market average. The primary method for achieving those returns is the leveraged buyout, or LBO. Consider a target company generating $100 million in annual operating profit. The private equity firm agrees to buy it for $1 billion. But the firm doesn't use $1 billion of its investors' money. They put down $400 million in cash and borrow the remaining $600 million. Here is the central mechanic. That $600 million loan is secured against the target company's own assets, not the private equity firm's. Over 5 years, the firm works to grow profits to $150 million. Meanwhile, they use the company's own cash flow to pay that debt down to $300 million. If they sell the company for $1.5 billion, they pay off the remaining debt and keep $1.2 billion in cash. The firm tripled its initial investment. The use of debt amplified the company's growth, turning a 50% increase in profit into a 300% return for the equity holders. This process relies on 3 specific drivers: debt, market timing, and operational change. But the same debt that boosts returns also increases the risk of failure. If the company's earnings decline, those fixed repayment obligations remain, which can lead to a rapid collapse of the equity value. This is the source of frequent public criticism. When a buyout carries too much debt, the subsequent cost-cutting often leads to significant job losses or company failure. For much of the 2010s, low interest rates made these risks easier to manage. Firms could generate profits through cheap borrowing and rising market prices, without necessarily needing to improve how the businesses were actually run. By the year 2026, the entire financial environment has drastically shifted. High interest rates have made debt expensive and have ended the era of rapidly rising market valuations. This makes it harder for firms to sell their companies at a profit. With those pathways narrowed, the cash distributions that investors expect have slowed to a crawl. To find liquidity, firms are turning to the secondaries market to trade stakes and are creating new vehicles to shuffle assets between funds, keeping capital in motion while they wait for better market conditions. In this restrictive era, firms can no longer rely on financial engineering to hit targets. They must generate value through direct internal changes to the business. This is driving a pivot towards sectors with stable, recurring revenue and a massive investment in AI-enabled tools designed to maximize efficiency within their portfolio companies. Success in this environment is no longer a byproduct of a rising tide. Profitability must now be manufactured through hands-on management and measurable increases in a company's bottom line. To keep the $7 trillion industry expanding despite these constraints, the major firms are searching for a new source of capital. They are redesigning their products for individual brokerage accounts and integrating private equity options directly into mainstream retirement plans. This shift marks a major new focus for the industry, the savings and retirement accounts of everyday individual households. Individual investors are being granted access to these funds, just as the historical advantages of the industry, cheap debt and effortless market growth, have become much harder to find.